Hello there, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of June 30th, 2025. Thanks for tuning in as we break down what's been going on in the economy and markets and what that can mean for you. As we close out the first half of 2025, it's clear the U.S. economy is slowing. Factors like tariffs, government spending adjustments, and shifts in immigration are contributing to this moderation in growth. However, a significant boost is expected from the reconciliation bill, particularly through strong tax refunds in 2026, which should stimulate activity. In the labor market, slower job creation is anticipated, but the unemployment rate's rise is expected to be limited by changes in immigration. Wage growth should remain steady, balanced between tight labor conditions and broader economic concerns. Regarding inflation, while recent readings have been modest, price increases are expected later this year and into early 2026 due to tariffs and increased consumer spending, before eventually returning to target. The Federal Reserve is maintaining a cautious stance on interest rates, reflecting ongoing uncertainties. In the equity markets, the concentrated outperformance of large U.S. technology stocks continues to be a key theme, suggesting that diversification beyond these areas may be prudent. For bond investors, long-term interest rates are finding a floor with attractive yields currently available. We'll also examine the U.S. dollar's recent declines and the compelling case for international equity. Finally, this review will underscore the importance of disciplined portfolio management and rebalancing, especially given recent market gains, to ensure your portfolio remains well positioned. As always, I'll be using JP Morgan's Guide to the Markets to help connect the dots. Feel free to pause the video if you want to take a closer look at the charts. All right, let's dive in.
The U.S. economy appears to be slowing. This is influenced by tariffs and their uncertainties, federal government cutbacks, and declining immigration and tourism. Real final sales of domestic product is a key indicator. While gross domestic product GDP measures total output, including inventory changes and net exports, real final sales focuses on actual sales to final buyers within the country, providing a clearer picture of underlying demand. This figure is expected to decline from 2.0% annualized growth in the first quarter to 0.2% in the second, and potentially a negative reading in the third. However, the reconciliation bill is expected to provide stimulus, first through lower income tax withholding from the third quarter, and notably very strong income tax refunds in 2026. This is expected to boost economic activity in the first half of 2026. Growth is then expected to moderate in the second half of 2026 as the refund effect fades and the lingering impacts of higher tariffs and lower immigration persist. A slower U.S. economy is expected to lead to slower job growth. Average monthly payroll gains are likely to fall below 100,000 for the remainder of 2025, before a slight reacceleration in 2026. However, the impact on the unemployment rate is expected to be mitigated by a significant shift in net immigration levels. Recent years saw elevated levels of immigration. Currently, however, there is an observable reduction in both illegal entries and the issuance of new legal immigrant visas. This change suggests that net immigration could fall to less than 250,000 per year. This represents a notable decrease compared to the annual averages observed in the decades prior to the pandemic, as well as the higher levels seen in the more immediate past. Such a reduction implies a more constrained labor force, which is expected to limit the increase in the unemployment rate to just 4.5% by the fourth quarter of this year, despite slower job creation. Regarding compensation, wage growth is expected to remain steady. This reflects a balance where ongoing tight labor market conditions, which typically support wage increases, are counteracted by broader economic concerns and recession worries during wage negotiations. Inflation remained relatively subdued through May, with year-over-year consumer prices rising 2.4%. This suggests the initial impact of tariffs has been limited so far. However, the effects appear delayed rather than avoided. As retailers bring in higher cost inventory, markups are likely to push prices higher later this year. According to JP Morgan, inflation is expected to climb to 3.5% by the fourth quarter based on the Consumer Price Index, and around 3.0% by the Fed's preferred gauge, the Personal Consumption Expenditures Deflator. Elevated inflation may persist into early 2026, partly due to stronger consumer spending tied to larger income tax refunds. Still, as the economy moderates in the latter half of next year, inflation is projected to ease closer to the Fed's 2% target. After reducing interest rates by 1 percentage point in the second half of last year, the Federal Reserve held its policy rate between 4.25% and 4.50% throughout the first half of 2025. JP Morgan projects only a modest 0.25% rate cut at most before year end. Two main reasons support this outlook. First, persistent policy uncertainty. Key questions remain regarding the government's approach to tariffs, immigration, and budget priorities. These decisions directly influence inflation, and the Fed is likely to wait for greater clarity before making significant moves. Secondly, inflationary pressures outweigh labor slack. According to the Fed's projections, inflation is expected to exceed the 2% target by more than unemployment falls below its 4.2% long-term average. This balance makes it difficult to justify aggressive rate reductions. Additional easing could become more likely if economic growth shows further signs of slowing in the second half of 2026. At the start of the year, a striking pattern emerged. The largest companies in the S&P 500 significantly outperformed the rest of the market, both in earnings and stock price gains. Much of this strength reflects the dominant position of U.S. technology firms, as well as a sharp increase in excitement and investment around artificial intelligence. However, in recent years, the stock performance of these mega cap firms has often run ahead of their earnings growth. As a result, valuations for this group now appear elevated compared to the broader market. Despite considerable volatility in the second quarter, this dynamic has remained intact. Today, the top 10 companies in the S&P 500 represent more than 38% of the index's total market value, a level of concentration that raises both opportunities and risks. For long-term investors, this may be a good time to reassess portfolio diversification. A strong run in mega cap stocks can offer impressive short-term gains, but market leadership can shift quickly if economic conditions, policy changes, or company-specific events reverse the trend. This chart depicts annual returns of the S&P 500 in gray, with the worst days of the year in red. In 1999, the market returned 20%. However, at one point in the year, the market was down minus 12%. On the day that the market was down like that, imagine an investor's joy if only they knew that the year would end up plus 20%. Or in 2020, with a pandemic low of negative 34% compared to the actual calendar year return of 16%. Scan over the many years of positive calendar year returns in gray compared to their intra-year lows in red. As of mid-year 2025, the S&P 500 is in positive territory, up 5%, excluding dividends year to date, after being down a whopping negative 19% earlier in 2025. Do be aware of what is happening in the economy and markets. But this slide illustrates why not to allow day-to-day volatility to weigh on you. Despite signs of a slowing economy, long-term interest rates have held steady in 2025. Several forces are keeping yields elevated. The Federal Reserve has not lowered rates further. Inflation expectations have picked up, and increased Treasury issuance following the reconciliation bill and a higher debt ceiling continues to add upward pressure. Together, these elements have offset the typical decline in rates that might accompany slower economic growth, keeping long-term yields in a fairly stable range. From an investment standpoint, this environment doesn't offer a compelling case for making big shifts in bond portfolios. Even if growth slows further, the upside for bond prices may be limited by high government borrowing needs and ongoing inflation concerns. Credit markets are also holding steady. Corporate bond yields remain low relative to treasuries, a dynamic known as tight credit spreads. This usually signals that investors see low risk of widespread defaults, which is consistent with the view that the economy will avoid a near-term recession. In this setting, maintaining a normal bond allocation still makes sense. With yields on the Bloomberg Bond Index near 5%, historical data suggests investors could see comparable annual returns over the next 5 years, especially if inflation begins to ease in late 2026. The U.S. dollar has declined sharply since the beginning of the year. This movement likely reflects several factors: the dollar's strong valuation at the start of 2025, persistent U.S. trade deficits, and growing concerns among investors, both domestic and international, about the concentration of their portfolios in U.S. assets. Policy uncertainty under the new administration may also be contributing to these shifts in sentiment. Historically, one of the primary supports for the dollar has been the higher interest rates offered on U.S. government debt compared to bonds in other major economies. As of now, that interest rate advantage remains intact. For example, the European Central Bank appears more willing than the Federal Reserve to lower rates in the near term, which helps sustain demand for U.S. assets and may keep the dollar from falling further in the short run. However, the longer-term outlook is less favorable. If U.S. economic growth slows, as expected later in 2026, and the country continues to run large trade deficits, downward pressure on the dollar is likely to build over time. International stocks strongly outperformed U.S. equities in the first half of 2025. This was driven not only by better local market performance, but also by a declining U.S. dollar, which boosted returns for dollar-based investors holding foreign assets. Given this notable outperformance, it's understandable that some investors may be wondering if the opportunity has already passed to increase international allocations. JP Morgan believes the answer is no and highlights 3 reasons. First, even after the rally in 2025, international stocks remain attractively valued compared to their U.S. counterparts. Valuations overseas are still lower by several historical measures, creating room for continued relative strength. Second, the U.S. dollar is still considered overvalued given America's persistent trade deficits. A further decline over the coming years would continue to support international returns when translated back into dollars. Third, after years of U.S. market dominance, many investor portfolios remain heavily tilted toward domestic stocks. This means most investors are still underexposed to international markets relative to what would be considered balanced for long-term asset allocation. This slide highlights the significant role that currency movements can play in shaping the returns of international investments. So far in 2025, a weaker U.S. dollar has amplified international equity returns. In the Eurozone, for example, roughly half of year-to-date returns came from currency translation rather than local market performance. Emerging markets benefited from a 4.5% currency boost, while Japanese equities saw an even stronger 9.1% lift from the declining dollar. In contrast, currency had little net effect on Chinese investments and even slightly detracted from local returns. To put this in context, when the U.S. dollar weakens, each foreign currency denominated gain converts into more dollars, increasing returns for U.S. investors. Conversely, when the dollar strengthens, the same local gains translate into fewer dollars, reducing total return. This currency translation can add to or subtract from otherwise positive performance abroad. Compared to 2024, when the dollar was stronger, returns from Japan, the Eurozone, and emerging markets were negatively impacted by currency effects. Over the past 15 years, currency movements have generally reduced international returns. On average, the dollar has acted as a headwind for Japanese and emerging market investments, and slightly for China and the Eurozone as well. Over the past 5 to 6 years, investors have navigated extraordinary economic and geopolitical events. Despite the volatility, overall investment returns during this period have been strong. However, those gains have not been evenly distributed across asset classes. Without regular rebalancing, many portfolios have drifted toward higher concentrations in equities, taking on more risk than originally intended. As shown in the accompanying chart, a portfolio that began in 2019 with a 60% allocation to stocks and 40% to bonds would now hold over 70% in equities, assuming dividends and interest were reinvested within each asset class. As always, asset allocation should be evaluated through the lens of individual goals, risk tolerance, and time horizon. For some investors, this may be a logical point to review positioning and consider whether adjustments are warranted, especially in light of recent gains and shifting conditions. As the second quarter wrapped up, asset class performance continues to highlight the value of diversification, especially international diversification. Developed market equities remain the standout performers in 2025, returning 19.9% year to date. Emerging market equities follow closely behind with a 15.6% gain. Large cap U.S. equities rebounded nicely after a weak first quarter. While they were down 4.3% at the end of Q1 of 2025, they've recovered to 6.2% through June. Commodities, which led early in the year, remain strong with a 5.5% return. Fixed income sectors have also held up well. High yield bonds are up 6.8%, and broader fixed income markets have gained 4.0%. Real estate continues to be challenged by high interest rates, but still managed a modest gain of 1.8%. The only major asset class posting negative returns is small cap U.S. equities, down 1.8% year to date. That concludes this quarter's economic and market review. Thank you for watching all the way through. If you'd like to discuss anything further, from asset class trends to how they relate to your personal goals, I'd be happy to connect.